The day you retire is the day the tax autopilot turns off. Most people do not understand that until it is too late for 30 or 40 years. Money came out of your paycheck before you ever touched it. Your employer withheld federal tax, Social Security tax, Medicare tax. The machine ran quietly in the background. You worked. They withheld. April arrived, you filed, maybe you got a refund, maybe you owed a little, but the system had rails under it. Then one day the paycheck stops. That is the moment most people think they have escaped complexity. I have lived long enough to tell you the opposite is true. The day the paycheck stops is the day complexity finally stops hiding from you. The IRS does not retire because you retire. It simply changes costume. It stops showing up as withholding and starts showing up as choices. Every choice has a cost. Every missed form has a cost. Every delay has a cost. And because the old rails are gone, the mistakes no longer arrive as little inconveniences. They arrive as penalties, taxable benefits, Medicare surcharges, double distributions, unnecessary income spikes, and money that leaves your house without ever improving your life. That is why I want you to think about retirement taxes in one simple way. When you were working, you were riding in the back seat of a car that mostly drove itself. When you retire, somebody quietly moves you into the cockpit. Most retirees still think they are passengers. That is the whole disaster. I have watched people work honestly for decades, pay off the mortgage, raise children, save in retirement accounts, and still lose thousands of dollars in the first 2 years of retirement because nobody explained what the IRS expected the moment wage withholding disappeared. They did not get cheated because they were foolish. They got punished because the operating system changed and nobody told them where the new controls were. If you want wealth to survive retirement, you need to stop thinking like a former employee and start thinking like the chief operator of a small cash flow enterprise. That enterprise is your life. It has revenue streams. It has tax exposures. It has timing decisions. It has brackets, thresholds, hidden cliffs, and avoidable leaks. If you leave it unmanaged, the money does not merely drift away. It gets stripped from you by rules that were always there. I call the first mechanism the withholding vacuum. A vacuum is dangerous because it looks like nothing. No smoke, no fire, no siren, just absence. In retirement, the absence is withholding while you were working. Tax was removed before you got comfortable with spending what was left. In retirement, income arrives from Social Security, pensions, IRA withdrawals, dividends, maybe rent, maybe interest, maybe part-time consulting, and most of those streams do not withhold enough tax to protect you. Some do not withhold anything unless you tell them to. Others withhold a flat rate that has no relationship to the rate you will actually owe. That is how a perfectly responsible person ends up with a tax bill and an underpayment penalty at the same time. The insult is almost elegant. You owe the tax you should have expected. And on top of it, the government charges you for not sending it in on the schedule it wanted. For the first quarter of 2026, the underpayment penalty rate in the source material was 7%. For the second quarter, it dropped to 6%. The penalty is calculated daily on the underpaid amount for each quarter. That does not sound dramatic until you put a real life on top of it. Say a retiree ends the year with a total tax liability of $14,000. Say only $8,000 was withheld across Social Security, IRA withdrawals, and whatever else. That leaves $6,000 underpaid. No estimated payments were made because nobody mentioned them. Suddenly there is a penalty sitting on top of the $6,000. And now the retiree is angry at the bill, ashamed of the oversight, and confused about how retirement was supposed to feel simpler. This is not a moral failure. It is a systems failure. The first correction is not glamorous. It is estimated tax payments the 15th of April, the 15th of June. The 15th of September, the 15th of January, those dates matter because the IRS measures your obedience across the year, not just at filing time. The safe harbor rule matters because if you pay 100% of last year's S-tax liability through withholding and estimated payments, or 110% if your income was above $150,000, you can avoid the penalty even if the current year turns out larger than expected. That is not trivia, that is a shield, and there is a cruel little detail almost nobody tells seniors. If you are at least 62, retired in the last 2 years, and had reasonable cause for underpaying, the IRS can waive the penalty. But like many useful things in the tax code, it does not walk up and introduce itself. You have to file Form 2210 and request the waiver. If you do not know the form exists, the waiver may as well not exist. That is how retirement works. the benefits do not go to the people who deserve them. They go to the people who know where the levers are. The second mechanism is the Social Security tax trap. Nothing irritates people quite like discovering that the benefit they thought they had earned cleanly can become taxable because of income from somewhere else. That is not just annoying, it is destabilizing because it teaches retirees the wrong lesson at exactly the wrong time. They think, I am getting older, I am living more conservatively. Why does it feel like every extra dollar wakes up another tax bite? Because it does. The IRS uses something called provisional income. I do not care whether the name sounds elegant. The effect is brutal. You take adjusted gross income, add any tax-exempt interest, and then add half of your Social Security benefits. If that number crosses certain thresholds, part of your Social Security becomes taxable. For a single filer, the thresholds are $25,000 and $34,000. For married couples filing jointly, they are $32,000 and $44,000. Between those ranges, up to 50% of benefits become taxable. Above them, up to 85%. Those thresholds were set decades ago and never adjusted for inflation. That is one of the dirtiest little truths in retirement taxation. A threshold frozen in old dollars quietly expands its reach every time the value of money shrinks. What once caught the comfortable now catches the ordinary. That is why retirees who do not feel rich keep discovering that the tax code treats them as if they are. And it gets worse because this is not a normal tax effect. The extra dollar you pull from somewhere else does not only get taxed itself, it can also drag previously untaxed Social Security into the taxable zone. That means the effective marginal tax rate is often much higher than the retiree imagines. He thinks he is evaluating one more distribution. In reality, he is setting off a second tax reaction behind the wall. You do not beat a trap like that with optimism. You beat it with sequence and awareness. The third mechanism is the senior bonus blind spot. Retirement is full of moments where the government gives with one hand and quietly waits to see whether you are alert enough to notice. In the source document, the new law created a $6,000 senior bonus deduction per qualifying taxpayer for tax years 2025 through 2028. With income limits and a new Schedule 1A on top of the regular standard deduction, on top of the existing additional standard deduction for seniors, $12,000 for a married couple, if both qualify before phase-outs. Think about what that means. The code contains actual relief. The relief has a shelf life. The relief may not be flagged automatically by every software system, and the retiree who spent an entire career believing tax forms were someone else's specialty may never ask the one question that matters. Did you apply it? That question is worth real money, not symbolism, not theory. Money. Most people assume that if something benefits seniors, the system will automatically identify seniors and apply it. That belief is naive. Tax preparation, whether done by a person or software, often runs on habits. Habits become defaults. Defaults become expensive. You can live with the wrong habit for 5 years and never know the leak was there. I learned a long time ago that wealth is not merely about making good decisions. It is about preventing silent bad decisions from repeating themselves. A one-time mistake is a bruise. An automated mistake is a parasite. The fourth mechanism is the double distribution hit. If you have a traditional IRA or 401k, the government eventually stops being patient at age 73. It once required minimum distributions. People hear that and reduce it to a calendar reminder. They should hear something else. They should hear compression risk. You are allowed to delay the first required minimum distribution until the 1st of April of the year after you turn 73. Many people hear that and think delay means flexibility. It often means a trap because once you delay, you can wind up taking 2 required minimum distributions in the same tax year, one for the prior year by the 1st of April, then the current year by the 31st of December. Now stack that on top of Social Security, stack it on top of pension income. If you have one, stack it on top of dividends interest. And anything else still flowing through the house. Suddenly, one harmless-looking delay creates a tax bulge. The bulge can push you into a higher bracket. It can make more of your Social Security taxable. It can trigger Medicare surcharges. It can raise costs that are not even labeled taxes yet, are taxes in all but name. This is why I do not like decisions made in isolation. A retiree with a $500,000 IRA might have a first RMD around $19,200, using the figures in the source, delay it, and suddenly almost $38,000 of distributions can land in 1 year. That is not flexibility, that is bunching. And bunching is one of the favorite ways the tax code makes decent people feel, as if retirement became more fragile than work. The penalty for missing an RMD altogether is not symbolic either. 25% of the amount missed, dropping to 10% if corrected in time under the cited rule set. That is the government telling you it no longer regards the withdrawal as optional. A wise retiree does not merely know the date. He knows what the date does to the rest of his system. The fifth mechanism is the charity valve. There are times when the code offers you a legal path that is so clean it feels almost suspicious. If you are at least 70 and a half, you can route up to the allowed amount each year directly from an IRA to a qualified charity. The donation counts toward your required minimum distribution, but does not count as taxable income. That matters more than most people realize. When income stays out of adjusted gross income, it does not push more Social Security into taxability. It does not raise the odds of triggering IRMA. It does not swell the visible top line of your return in the same way. That is the difference between generosity done casually and generosity done intelligently. I have no interest in telling people to become charitable merely for tax reasons, but if a person was going to give anyway, then giving through the wrong channel is simply financing government friction. The heart may be generous, but the method can still be stupid. And in retirement, stupidity compounds just as efficiently as wisdom does. I call it a valve because that is what it is. It releases pressure from the system without making the rest of the machine overheat. The sixth mechanism is the gap year window. This is one of the few moments in retirement planning where time itself becomes a tax asset. The years between retirement and age 73, before required minimum distributions begin, and sometimes before Social Security starts, are often your lowest visible income years. Most people waste them because low income feels like a time to breathe. I prefer to see it as a time to reposition. Those years are when Roth conversions can be most powerful. You move money from a traditional IRA to a Roth, pay tax now, and then that money grows under a different future. Withdrawals later can be tax-free. There are no lifetime RMDs from your own Roth. You are essentially choosing a smaller known pain today over a larger unknown pile of complications later. That is a very Buffett way of thinking. I have always preferred a tolerable certainty over an avoidable future mess. What makes the gap years especially powerful is bracket control. You can convert enough to fill the current bracket without spilling into the next one. You are not doing it blindly. You are not converting because headlines say conversions are smart. You are converting because the tax system is temporarily offering you a lower toll road, and it would be foolish not to use it. A down market only improves the logic if account values are lower. The same number of shares or units can be converted at a smaller taxable amount. When the market recovers inside the Roth, the recovery belongs to the tax-free side of the wall. In the source example, converting $50,000 during a market decline and later watching it recover to $60,000 inside the Roth means you paid tax on the smaller number and let the rebound happen in the better compartment. That is not magic. That is sequence. Most people spend too much of life asking which asset will do best. Often the better question is which account should own the recovery. The seventh mechanism is the IRMA cliff. Retirees discover this one the way hikers discover cliffs in fog. They are walking on what feels like ordinary ground. Then one extra income event suddenly changes their Medicare premiums. The name is bureaucratic enough to make the danger sound boring. Income-related monthly adjustment amount, IRMA, but boredom is one of government's favorite disguises. If your modified adjusted gross income crosses certain thresholds, Medicare adds surcharges to Part B and Part D. The surcharge is based on your tax return from 2 years prior. That delay is important. It means today's thoughtless income spike can become tomorrow's premium shock long after the retiree has forgotten what caused it. That one-time capital gain, that large IRA withdrawal, that oversized Roth conversion, that delayed RMD bunching, none of them exist in a vacuum. They have aftershocks. A lot of retirement mistakes come from looking at taxation as if it ends on the 15th of April. It does not. It leaks into healthcare costs, it leaks into benefit taxation, it leaks into cash flow planning. A person who says, I can afford one more distribution, may really mean, I can afford the first bill and have not noticed the second bill hiding behind it. That is why I tell people to stop viewing retirement income as disconnected events. It is one long river. Every tributary changes the water level somewhere else, and there is a practical dignity in understanding this. A person who knows where the cliffs are does not need to live in fear. He simply walks with his eyes open. If a one-time event pushes him over an Ermaya threshold, he can at least know the mechanism, and in some cases use the available form to request relief after a life-changing event. Again, the system does not disappear, it only becomes less expensive. When you know its language, the eighth mechanism is the address and letter trap. Wealth can be lost through complexity, but it can also be lost through laziness. I do not mean moral laziness. I mean the ordinary human habit of postponing paperwork that looks annoying. You move in retirement, you downsize, relocate, go closer to children, or leave the cold for someplace kinder. The IRS still has the old address. A notice goes there, you never see it. A deadline passes. Suddenly your right to contest, respond, negotiate, or appeal has narrowed or vanished. The government is ruthless about deadlines, because deadlines are how bureaucracies keep the human being at a distance. If you ignore a letter because you do not understand it, you have not delayed the problem, you have surrendered time, which is usually the most valuable asset in the dispute. Every notice has a clock inside it. That is why updating your address is not clerical trivia. It is a control function. So is opening every letter immediately, not next week, not when you are in a better mood. Now, a CP-14 is not the same as a CP-2000. A levy notice is not the same as a balance. Due notice, but they all share one trait. They get more expensive. If you let them ripen in a drawer of retirees, sometimes imagine that because their life has slowed down, official deadlines will somehow become less sharp. They do not. The ninth mechanism is deduction drift. People think retirement makes taxes simple because wages stop. I think retirement makes people dangerous to themselves because habits harden. One of the most expensive habits is filing the same way year after year without rerunning the math. The standard deduction changes. Senior add, ons change, new temporary provisions appear, state and local tax caps change. Mortgage interest falls as a loan matures. Charitable giving changes. Property tax burdens differ by state. Yet millions of people keep filing on autopilot because autopilot once worked. There it is again. The word that ruins retirement, autopilot in the source. A married couple over 65 could have a combined standard deduction and related add-ons that rise above $47,000 under the cited rules. For many households, that means itemizing no longer wins. For others in high-tax states, the enlarged SALT cap and their specific numbers could push itemizing back into the lead. The point is not whether one side always wins. The point is that the answer is no longer obvious and must be recalculated. People love formulas because formulas relieve them of thought. But in retirement, failure to think is expensive. The 10th mechanism is identity. This is the part almost nobody teaches because it sounds less technical and therefore less important. I think it is the most important part of all. Retirement does not merely change your income sources. It changes who you have to become to protect your wealth. When you were an employee, the system tolerated passivity, not because passivity is wise, but because wages and withholding are a simple corridor. In retirement, passivity becomes leakage. The retiree who wins is not always the one with the largest account. It is often the one who accepts the new identity fastest. The former employee becomes a household chief financial officer. The passive filer becomes a timing strategist. The person who once thought taxes happened in spring begins to understand that taxes happen all year. In every distribution choice, every withholding decision, every conversion amount, every charitable gift, every premium threshold, every letter opened on time, every bracket filled carefully, instead of spilled through carelessness. This is the identity flip that separates the retiree who keeps control from the retiree who drifts. You are no longer a paycheck receiver, you are the manager of a tax machine. And the irony is that this new role can be liberating once you stop resisting it, because control is not the same thing as anxiety. A man can fear a cockpit when he first sees the instruments, but once he knows what the instruments do, the cockpit becomes safer than the back seat. So let me tell you the operating system I would use if I were entering retirement from scratch today. I would begin with a simple principle. Never let a tax event surprise me twice. That means I would map every income source before the year begins. Social Security pension, traditional IRA withdrawals, taxable account dividends, interest, rental income, part-time work if any. I would not let these streams meet for the first time on a tax return. I would make them meet on paper in advance. Then I would decide where withholding belongs and where estimated payments belong. I would not assume 10% withholding from an IRA is close enough. I would compare it to my projected liability if Social Security were going to be taxed. I would make a deliberate decision on Form W-4V instead of letting the default make decisions for me. Then I would calculate provisional income before taking large distributions, not after. I would want to know whether an extra move would drag more of my benefits into taxability. I would stop asking whether I can withdraw more money and start asking what that withdrawal wakes up elsewhere. If I were under 73 and in the gap years, I would treat those years like valuable real estate. I would analyze Roth conversions annually, not ideologically. I would fill brackets intelligently. I would remember that the lowest income years in retirement are often the cheapest years in which to prepay future tax trouble. If I were over 70 and a half and already giving to charity, I would use qualified charitable distributions before I wrote checks from my checking account. Same generosity. Better architecture when required minimum distributions approached. I would not delay the first one into the following year without carefully measuring the double impact. I have no desire to give myself 2 tax headaches for the price of one. I would watch Medicare thresholds the same way I watch the edge of a bridge calmly, respectfully, without pretending they do not exist. I would remember that large one-time income events can travel forward 2 years and show up wearing a healthcare premium. I would rerun the deduction math every single year. Not because I enjoy tax forms, because repeating an old filing pattern merely because it is familiar is the financial equivalent of driving by looking only in the rearview mirror. I would keep my IRS address current. I would open every letter the day it arrived. I would rather face an ugly notice early than an ugly consequence late. And finally, I would talk to a competent tax advisor not as a sign of dependence, but as a sign of seriousness. There is a big difference between paying for help and outsourcing your judgment. I would never outsource judgment. I would gladly pay for precision. The old fantasy of retirement is that work stops and life becomes simple. The truer version is that wage work stops and hidden management begins. That does not make retirement worse. It makes retirement real. If you understand that, you begin to see the entire game differently. Retirement is not a finish line where the math goes away. It is the stage where the math finally becomes visible. The people who struggle are often the ones still trying to live under the old employment script. The people who do well are the ones who accept that the script changed and learn it fast. I want to say something gentle but firm to anyone near retirement age who still believes this is all too complicated. Complicated compared to what? Compared to losing money you did not need to lose. Compared to paying penalties that could have been waived. Compared to discovering in April that your Social Security became taxable because you never learned the formula. Compared to taking 2 required distributions in 1 year because the deadline sounded harmless. Compared to pushing yourself over a Medicare line because one careless withdrawal was treated like an isolated event. Compared to overpaying or underclaiming because your preparer or software stayed on the old habit. And you never asked one more question. A lot of people confuse discomfort with impossibility. This is not impossible. It is simply unfamiliar. And unfamiliar things get easier the moment you stop approaching them like a victim. That is the final choice retirement forces on you. You can remain the former employee who expects a vanished system to keep protecting him, or you can become the capital steward your family actually needs. One identity drifts toward surprise bills, avoidable penalties, accidental tax spikes, and quiet resentment. The other builds a household that knows where the money is going, why it is going there, and how to stop the needless leakage. I know which path I would choose. I would choose the path where every dollar has a job before the IRS invents one for it. I would choose the path where tax timing is used on purpose instead of suffered by accident. I would choose the path where retirement is not a foggy exit from work, but a deliberate transfer from employee income to managed capital. And if I had to condense all of this into one sentence, it would be this: the moment you retire, the government stops withholding your mistakes from you. That is why you must stop being passive before retirement teaches you the lesson in dollars.